Ever wondered how a company that sells across state lines actually figures out its taxes? It's
Yeah.
definitely not as simple as, just paying one big check to Uncle Sam.
Not even close.
So today, we're doing a deep dive into the surprisingly complex world of state and local taxes. We're pulling out the crucial insights.
And what's really interesting here, I think, is how these rules, which most people never really see, have such a huge impact.
Right.
They really shape how businesses operate, where they decide to set up shop, all that stuff. It's fascinating when you get into it.
Okay, let's unpack this then. Our research jumps right into this core idea.
Hmm.
A company owes federal income tax, sure, but also taxes in its home state
Mm-hmm.
and in any other state where it has something called nexus. So first things first, what is nexus?
Nexus, simply put, it's the minimum connection. It's the minimum level of contact a company needs to have with a state before that state can legally tax them.
So it's like a legal threshold.
Exactly. You cross that line, the state can say, okay,
Yeah.
you're doing enough business here, you owe us.
And how do companies usually cross that line? Is it just like setting up an office, or is it more subtle?
Oh, it's definitely more nuanced than just an office. Traditionally, the big triggers are having property, payroll, or sales within a state.
Okay. Property, payroll, sales.
Right. But here's the tricky part. Every single state has its own specific laws about what exactly triggers nexus.
Ah,
So it's really not a one-size-fits-all deal. You're looking at like 50 slightly different rule books.
50 different rule books. That sounds potentially messy for
It
businesses.
can be.
But our sources also mention federal law stepping in sometimes, offering some protection. What's this Public Law 86272 about?
PL 86272. Okay, so think of that as a very specific shield from the federal government.
Shield.
Yeah, it basically tells states, hey, back off. You can't impose a net income tax on this company.
Net income tax specifically.
Correct. If, and these are big ifs,
Yeah.
if the company's only business activity in your state is soliciting orders for tangible personal property.
Tangible personal property, so physical goods, stuff you can touch.
Exactly. Like computers, clothes, widgets. Not services, not software downloads, physical stuff.
Okay.
And second, those orders have to be sent outside the state for approval or rejection.
Got it. Sent out.
And third, if the order is approved, it has to be filled by shipment or delivery from outside the state too.
So soliciting physical goods, orders approved elsewhere, shipped from elsewhere, that's the protection.
That's the narrow window.
Wow.
And it applies pretty broadly, individuals, corporations, partnerships, LLCs.
Who isn't protected?
Well, it doesn't protect companies that are actually incorporated in that state. Makes sense, right?
Mm-hmm.
Nor does it protect individuals who live there.
Yeah.
And critically, remember, it's only about net income taxes.
Yeah. Okay. So not other taxes.
Right. It doesn't stop states from hitting you with sales and use taxes, or franchise taxes, which are sometimes just a fee for existing in the state, or even gross receipts taxes, which tax your total revenue before expenses.
Wow. So even with that shield, a state might still tax you in other ways.
Absolutely. And you have to realize states tend to interpret solicitation under this law very, very narrowly. They're looking for any other activity that goes beyond just asking for the sale.
They want to find a reason it doesn't apply.
Pretty much.
Yeah.
Any ambiguity usually gets resolved in the state's favor.
Yeah.
It's a constant push and pull.
Okay, so PL 86272 is a specific shield for a specific activity. What about everything else? What kinds of things definitely trigger nexus besides the obvious physical store or office?
Well, our research lists quite a few common ones. Owning or even just leasing property, real or personal, is a big one.
Okay, property.
Sending employees into the state, even if it's just for training or short-term work.
Training counts? Interesting.
Yep, soliciting sales, of course, unless you fit exactly into that PL 86272 box we just talked about.
Right.
Providing services in the state, like installation or maintenance, even if you hire a local third party to actually do the work for you.
So outsourcing the service doesn't get you off the hook.
Not necessarily. And things like accepting or rejecting sales orders within the state or handling customer returns there, those can also cross the nexus threshold.
Man, that's a lot to keep track of. It sounds like it'd be easy to accidentally create nexus somewhere.
It can be.
Can we use an example? Maybe that Hundley Corporation one. That might help make it stick.
Sure, let's do Hundley. So they sell computers. They're incorporated in California, live there too.
Okay, home-based California.
Right. They also solicit sales in Oregon, Arizona, and Colorado.
Got it.
Now, in Arizona, they do more than just solicit. They actually provide installation services for their computers.
Okay. That's service beyond just asking for the sale. So Nexus in Arizona.
Bingo. Nexus in Arizona and in Colorado, they conduct employee training sessions at a rented facility.
Training again. So Nexus in Colorado too.
Correct. Now, what about Oregon? The info says their only activity there is soliciting sales for the computer's tangible personal property. Orders approved and shipped from California.
Okay, so that sounds exactly like the PL 86272 scenario.
It does. So Hundley likely is protected from Oregon income tax by that federal law.
But they'd still have Nexus in California, Arizona, and Colorado.
Exactly. It really shows how one extra activity, like installation or training, can make all the difference for income tax purposes.
That clarifies it a lot. So let's say Hundley does have Nexus in California, Arizona, and Colorado. They're on the hook. How do they figure out how much income each of those states gets to tax? That's where allocation and apportionment come in, right?
Precisely.
Do they mean the same thing? They sound kind of similar.
They're often used together, yeah, but they do different jobs. Think of it like sorting your income into different piles before you divide it up.
Okay.
The starting point for all this is usually the company's federal taxable income. Line 28 on the corporate return, generally.
Got it. The total pot.
Right. Then comes allocation. This deals with what's called non-business income.
Non-business income.
Yeah, income that's not from the company's main business operations, like maybe they have some investments on the side.
Right.
That non-business income gets allocated, meaning assigned entirely to one specific state, usually the company's commercial domicile, their headquarters state.
So investment income like dividends or interest, that just goes to the home state.
Typically, yes. Or, say, rental income from a property they own but aren't using in the business, that income is usually allocated to the state where the property is located.
Can you give us that shoe corporation example? I think that helps illustrate the non-business part.
Definitely. So imagine this shoe company sells shoes, that's their main thing, in a couple of states. They've got some extra cash lying around, not needed for daily operations, so they invest it in stocks and bonds. Plan is to sell them later for a new warehouse or something.
Okay, investing spare cash.
Right. Because that investing isn't part of their shoe-selling business. Any dividends, interest, or capital gains from those stocks and bonds would likely be classified as non-business income.
And allocated where?
Allocated entirely to the state where the shoe company has its main headquarters, its commercial domicile. The other states where they just sell shoes wouldn't get to tax that specific investment income.
Okay. So allocation sorts out the non-business stuff first, sends it to one place. What about the rest, the main business income?
That's where apportionment comes in. The income that is related to the main business, the business income that gets divided up or apportioned among all the states where the company has nexus and does business.
Okay, so the shoe-selling profits get divided.
Exactly. And the way it's divided is using something called an apportionment factor.
The apportionment factor. That sounds important. How's that calculated? Is there a standard formula?
There's a common approach, though states can vary it. Many states use a three-factor formula based on property, payroll, and sales.
The same things that often trigger nexus.
Often, yes. The idea is to measure how much of the company's economic activity happens in that state.
So how does the formula work?
Basically, you figure out the percentage of your total property that's in state X, then the percentage of your total payroll in state X, then the percentage of your total sales in state X.
Okay, 3 percentages.
Right. Then in the traditional formula, you add those 3 percentages up and divide by 3 to get an average percentage for that state. That's your apportionment factor.
So like if 10% of your property, 15% of your payroll, and 20% of your sales are in state X, you'd average those.
Exactly. 10 plus 15 plus 20 divided by 3 is 15%. So state X's apportionment factor would be 15%. Some states might weigh sales more heavily or use different factors, but that's the classic model.
This sounds like it could get really math-heavy fast.
Yeah.
Can we use that Kansas corporation example to see how it plays out in terms of actual taxable income?
Absolutely. Let's look at that example. We have a corporation based in Kansas. They also do business in Missouri, Oklahoma, and Nebraska.
4 states involved.
Right. The example tells us they have $10,000 of non-business income.
Which gets allocated.
Entirely to Kansas, their home state. And they have $100,000 of business income that needs to be apportioned.
Okay.
So they run the calculations, property factor, payroll factor, sales factor for each state. They average them out. The result is apportionment factors. Kansas gets 50%.
Half the business income goes to Kansas?
Missouri gets 27%, Oklahoma gets 15%, and Nebraska gets 8%. adds up to 100% of the business income being divvied up.
Okay, so how much total income is taxed by each state then?
Okay, Kansas, the home state, taxes two things.
Mm.
The $10,000 of non-business income allocated to it, plus its 50% share of the business income, which is $50,000.
So 10K plus 50K plus 50K plus $60,000 taxed by Kansas.
Perfect. Now, Missouri, Oklahoma, and Nebraska, they only tax a portion share of the business income.
Ah, they don't get any of that non-business income.
Correct. And so Missouri taxes $27,000, 27% of the 100K. Oklahoma taxes $15,000, 15% of 100K. And Nebraska taxes $8,000, 8% of 100K.
That really shows how the income gets split based on where the business activity happens. The non-business stuff stays home, the business stuff gets shared.
Precisely. It's the fundamental logic behind multi-state taxation.
Okay, let's pivot slightly to something that sounds a bit more advanced, but really interesting. This idea of controlled taxpayers and states maybe combining income.
Right.
It sounds like states trying to prevent companies from playing games with their structures. What's going on there?
That's a good way to put it. See, unlike the IRS, most states don't have the same kind of complex rules for adjusting transfer prices. The prices related companies charge each other.
Okay, less power there.
But many states do have laws that let them force related companies to file a combined tax return instead of separate ones.
Combine them. Why would they do that?
They do it if they think filing separately doesn't accurately show how much business is really being done within their state. Basically, if they suspect income is being artificially shifted out through intercompany deals.
Ah, okay. To get a truer picture of the profit earned in their state.
Exactly. And that whole company OP company example in our sources is a perfect illustration of why states need this power.
Yeah, let's walk through that one. It sounds kind of elaborate.
It is, a bit. So you've got Hold Company, set up in Delaware, doing nothing but holding stock and lending money.
Okay, a holding company.
It owns OP Company,
Yeah.
which operates entirely in State X. Holdco owns 100% of OPCO.
Got it. Parent in Delaware, subsidiary in State Act.
Now here's the maneuver. Every single day, OP Company pays out all its cash as a dividend to Hold Company.
Of all its cash, daily.
Daily. Then, the very next morning, Hold Company lends that exact same cash right back to OP Company and charges interest on that zone, let's say a fair market rate.
Okay, so money goes up as a dividend, comes right back down as a loan. What does that achieve?
Well, think about OP Company's tax return in State X.
Yeah.
That interest it pays to Hold Cup, let's say it's $10 million a year, is a deductible expense.
Right. Interest expense reduces taxable income.
Exactly. So OP Company's income reported to State X is $10 million lower than it otherwise would be. State X collects less tax.
But wait, federally, doesn't Holdco have $10 million of interest income that cancels out OPCO's deduction on a consolidated return?
Precisely. For federal taxes, it's a wash. The IRS doesn't care much if the interest rate is reasonable. But State X usually requires separate company returns, not consolidated ones.
Ah. So on OPCO's separate State X return, there's just the big deduction and State X loses out.
You got it. That's the potential loophole.
So how does the state fight back?
With that power to combine, if State X's tax authorities can force Hold Company and OP Company to file a combined State X return.
Then the interest income and the interest expense are on the same return again.
Exactly. OP's $10 million deduction gets canceled out by Holdco's $10 million income right there on the State X combined return. The state then taxes the real operating profit of OP Company before those internal payments.
Wow, that's a powerful tool for the states. It lets them look through the structure.
It really is. It shows they're aware of these kinds of planning techniques and have ways to ensure the tax base reflects the actual economic activity happening within their borders.
What a fascinating deep dive. We've gone from the basics of Nexus, just figuring out if you owe tax, through the narrow federal shield of PL 86272, then into how income gets split using allocation and apportionment.
Sorting the piles and slicing the pie.
Exactly. And finally, seeing how states can counter complex structures with combined reporting. It's definitely complex.
It really highlights that constant dynamic, doesn't it? Businesses looking for efficiency and tax optimization, states looking to protect their revenue base and ensure fairness. These aren't just dry rules. They drive major strategic decisions.
Absolutely. And for you listening, even if you're not, a tax accountant, getting a grasp of these concepts, nexus, apportionment, it gives you such valuable insight. It helps you understand business news, why companies make certain location choices, how our whole interconnected economy works on this level. It's a real shortcut to being better informed.
Couldn't agree more. And maybe a final thought to leave folks with. As business becomes more and more digital, more virtual, Think about how these concepts might struggle. What does property or payroll even mean for a purely online service? How do you define nexus when there's no physical presence?
Ooh, good question.
How do you fairly apportion income from, say, cloud services accessed nationwide? The established rules are definitely being challenged. It's a space that's going to keep evolving, for sure.
A conversation that's definitely not over. Fascinating stuff.